economic growth is probably going to be a little bit slower than what consensus was looking for. Therefore, earnings growth is likely to be a little bit slower. And inflation is probably going to be a little bit higher.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
All right. Well, excited to be here for episode 34 of The Bull of Wall Street. I am Paisley Nardini, joined by my co-host Jim Warden, the CIO at Wealth Consulting Group. And we are very excited to have Ed Clisshold join us today. He is the Chief U.S. Strategist for Ned Davis Research. And I had the privilege of Ed joining me at a CFA Orange County event a couple months ago. And Ed presented his research on stage, which I found to be just really thought-provoking, very much resonated with how I think about markets. So I reached out to Ed afterwards and had asked him if he would be willing to join us on the podcast today. So Ed, thank you for joining us. And would love to have you share a bit more about kind of your career path and your history, and then we'll get into talk about markets.
Okay, great. Yeah, thanks. Yeah, thank you so much for having me. It was a pleasure to talk to you after that event in Orange County a couple months ago. And it's always fun to do these things a little more free flowing than a formal presentation. So good stuff. Yeah, so I have been in the business for about 25 years. For my first job, I was a client of Ned Davis Research. This was the late 90s when every time you turn on your quote machine, everything was green and things seemed to work. It was a new paradigm. And there was this Ned guy saying, I'm going to raise my hand here and say, this isn't how it normally works. And at some point, the music's going to stop. I'm going to stay in the market. I'm going to have my indicators to follow, but we need to be ready. And then, of course, when the music did stop in March of 2000, his clients were very prepared for that. I appreciated that as a client. And so after I finished business school, I reached out to NDR and fortunately, there was a spot for me. So I've had a few different roles here over the years, kind of climbed up as an analyst doing bespoke research for clients, and then worked my way over into the strategy area. The last decade or so, I've been the U.S. strategist. So focus on S&P 500, market cap, style work. And, really the big part of it is where the markets are going and using NDR's great resources of indicators and models and data to help guide our clients.
That's awesome. So a lot has transpired in the several decades that you've been there. I think it's always really cool also in this day and age just to see people stay put at a single firm, to show the growth that you've had, the views that you've had. So would love to kind of just jump right in. I mean, one thing that I'm thinking about as it's, July 14th. We're halfway through the year, essentially. The days are starting to get shorter. As we think about what may transpire over the back half of this year, I know you had shared some of your recent thought leadership, as well as kind of your views on the market. And again, a lot of this resonated with how I'm thinking about, expectations were quite lofty coming to this year. And then they got really kind of punched in the face with the tariff tantrum. And then I think what's been the biggest surprise is coming out of that tariff tantrum, how quickly everything rebounded. And essentially what that's telling us is that the markets are comfortable. They're pricing in essentially no further volatility in the markets as we look at where equities are back to from a valuation perspective. But I don't think it's as easy as that. I don't think it's smooth sailing from here on out. I do think in general at the Wealth Consulting Group, we are fairly bullish or optimistic. We just put out our mid-year review as well. So at Ned Davis, what are you guys thinking about for the back half of this year? And then we can start to kind of dive into some of those bits and pieces in a little bit more depth.
Yeah, it seems like it's one of those years where it feels like it's been decades, and we're only halfway through. There's so much has gone on, and I think where we are compared to the beginning of the year, after all the volatility, all the hand wringing, is that economic growth probably going to be a little bit slower than what consensus was looking for. Therefore, earnings growth is likely to be a little bit slower. And inflation is probably going to be a little bit higher. Now, there's a path here, and I think our base case is by similar to yours, where we can muddle through and do okay. We don't necessarily have to have a recession. Earnings growth can still be positive, and so that leads us to a modest overweight allocation to equities. And in terms of where to focus, we think one thing that has transitioned is we're kind of back to the slow growth environment. It actually favors large cap growth stocks. They don't need the economy to do very well to grow their earnings, and they've already, they certainly did take a real big punch in the gut during the first 10 weeks or so of the year. So some of their overvaluations were corrected. So that's kind of where we're thinking we are now. And of course, there was, as somebody who's kind of, I view myself as a reporter on the sidelines, talking about what's happening and guiding people have to make the really tough decisions about what to buy and sell. It was a fascinating time. And in some ways, it was almost a textbook waterfall decline, bottoming process, breadth thrust recovery, and now risk on to new highs.
Thank you. I guess my takeaway from that would be, it seems like large cap growth, large cap U.S. equities are always in vogue. And I'm hard pressed to find an environment where that isn't kind of what's pulling markets higher. For many reasons, I think we can all attest as to why that's the case. These are higher quality companies. They have more free cash flow, stronger balance sheets. They have greater margins. So all of those components combined, as you think about, and I know you wrote about this in one of your recent pieces, so I'd love to unpack this. Large cap versus small cap. What environment right now? Because we just saw this rally come out where we saw the cyclicals, leading. It wasn't the defensives that led the most recent rally. It was the cyclicals, which historically has favored small caps. What are we missing here? What environment would favor small caps? Or is it just something that's evolved in the marketplace, the composition, passive flows, whatever it may be that will prevent small caps from being able to lead those rallies that we see?
Yeah. First of all, to kind of dive into what you said just a little bit more, we looked at several different factors coming out of the lows in April and compared them to 15 and 20% kind of quick corrections in the S&P 500. What happens? Well, it tends to be risk on coming out. That means growth over value, low quality over high quality, dividend non-paying stocks over dividend paying stocks. And all of those actually outperformed as you would expect. The one exception was small caps. Small caps tend to do very well in these environments too. And it's basically been flat for the Russell 2000 versus the Russell 1000 since the April low. So it just didn't, kind of makes your head scratch what's going on. And I think that if you go back to, say, Fama French, the three-factor model, they said buy low price to book stocks, buy high beta, and buy small company stocks. That's what everybody who's taken a finance class the last 35, 40 years has learned. But the small company factor hasn't worked since 2011. I mean, that is beyond just about anybody's time horizon. And I think the main reason for it is the structure of the market has changed. It used to be, if you're a company, you're private, you're growing, you want to get kind of hyper growth. You access the capital markets by going public, selling your equity to the public. And then you could really hit the sweet spot of your cycle. So if you were buying a small cap index, you were getting some really good companies in there. You think about last year, Super Microcomputer was in the Russell 2000. Russell does a rebalance every June. So by the time you get to be, April, May, June, there's some bigger companies in the Russell 2000, and Super Microcomputer was kind of stuck in the Russell 2000. even though it's a really big company. And then S&P, which does their rebalancing on an ad hoc basis with the committee, they'd already moved up the S&P 500. It's this weird dynamic of a stock. Is it a large cap or a small cap? Well, it depends on who you ask, S&P or Russell. Okay, that hasn't happened in a few years. But before that, if you go back 15, 20 years, that happened every year just about. You could have 3, 5, 10 companies in the Russell 2 and the S&P 500 because they blew up in a good way. These companies had hit the sweet spot of their cycle. And so that's really the benefit of owning these smaller companies. But we don't get that anymore because companies stay private longer, Paisley. Why would you go public? You have to deal with the regulations, quarterly earnings from investors who want to know what are you going to do this quarter. You can just use private debt, use private equity. Don't go public until you're a mid cap or a large cap. So these are just they're not in the indices anymore.
Yeah.
That's the biggest challenge. And so you look at earnings growth the last decade or so for small cap indices, they tend to be lower than large cap indices. So I'm getting the more volatility, but I'm not getting the upside. So that's the challenge for small caps.
And it's been super frustrating, I know, for investors as well who believe in diversification, but perhaps there's unique or new approaches to thinking about diversification, whether it's from other asset classes or even within like large cap equities, thinking about some of those other factors like momentum or quality. And I know the value versus growth discussion is always on the table as well. And that's one that will continue to be refuted, debated time and time again. But maybe some, like just zooming out a little bit, but kind of staying on this relativity topic, small versus large is what we just discussed. How are you thinking about, and we can start to maybe talk about the health of some of the balance sheets and profit margins. I know that's a lot of what you've discussed lately is the margins on a lot of these companies have expanded, which allows for some of the more volatility, whether it's tariff related or earnings related, and how that feeds into these companies to absorb some of these risks that we see, because that's one of the biggest drivers of stock returns is the margins and their ability to be profitable. So maybe another question for you would be, as it relates to more of the cyclical parts of the market or the more defensive parts of the market within equities broadly, how are you guys thinking about the upside or the potential risks in those kind of two key areas of the market?
Yeah, it certainly seems like a cyclical period for the market. And again, coming out of the April lows, that certainly has been the leadership. If you're in, we can define defensive a few different ways. So just take a second. One way we define it is we call it SHUT. So that stands for staples, healthcare, utilities, and telecom. So those tend to be low beta defensive areas. And they, each sector has their own unique characteristics. For example, utilities last year had a great run for several months, not because they were defensive, but because they're kind of AI adjacent, the data center build out and demand for energy. But really, as a group, what they're going to need is a more defensive market. And they actually, outperformed quite well during the first quarter, as you'd expect when the market was somewhat weak, and then they've underperformed since. So what we would need would be a second half that's going to be a little bit more challenging. Now, in a post-election year, it's actually not uncommon to get some defensiveness, particularly get into the third quarter, August, September, October. So, if you're a longer term investor, maybe don't get too focused on that. But if you're thinking about when to deploy capital, or if you want to do a little bit of short term trading, there might be an opportunity for those sectors to do a little bit better for a few months.
Yeah, that makes sense as well. And then maybe my last kind of relative question would be U.S. versus international, right? And we can unpack maybe if you guys do have explicit thoughts on the dollar. I know that tends to be one of the key drivers. But as we're thinking about advisors building portfolios that are diversified, that has been an increasingly important topic as investors are thinking moving beyond U.S. large cap equities. Is the international story still have legs? Is that short-lived? Do you have any thoughts on that?
Yeah. So, well, first of all, look, I'm the U.S. strategist, so you can ask a surgeon what he's going to say. Cut, right? So I'm unabashedly in favor and believe strongly in U.S. exceptionalism. So with that aside, here's just an interesting stat, at least I think it's interesting, to kind of keep in the back of your mind. So what we have taken the MSCI Europe sectors, okay, and took their PE ratios and then multiplied them by their weight in the U.S. index. Okay, and then you compare it to the MSCI U.S. PE ratio. Before 2022, the fact that the valuation discrepancy went away, meaning that it looked like the U.S. was more expensive, but it wasn't. It was just the U.S. had higher PE sectors like technology,
Yeah, sector anomalies. Yeah.
Yeah. Since 2022, that's gone away. The U.S. is still more, even on a sector adjusted basis, U.S. is still more expensive. And that valuation got closed a little bit in the first quarter or so, but the U.S. is still a little bit expensive. So I think there is a potential valuation play here. Of course, you always need a catalyst. Valuations can stay that way for a long time.
Yeah.
So there's certainly diversification benefit to being outside of the U.S.
I think we would. Go ahead.
So I was just going to mention that the dollar certainly plays a huge role if you look at returns, if you're hedged or not. But the dollar seems to want to continue to go lower. The Trump administration wants it to go lower. I think if the Fed cuts rates a couple times later this year, which is possible, that'll aid further dollar weakness.
Yeah, and I do think too, some thoughts that we've had here on the investment strategy committee at the Wealth Consulting Group is not necessarily like the US exceptionalism, but in a sense, yes, thinking about the composition of the companies that we have here in the US from an innovation, AI, the earnings growth, the higher margins. That's something that Jim has spent quite a bit of time on. So Jim, I don't know if you have maybe thoughts or further questions on that topic of just the composition of companies here in the US. And then we can even talk about what impact tariffs may have on some of those US companies.
Yeah, that's good. And I apologize. I had to cut out. I had some audio issues, but I'm glad to be back.
You're back.
And so Ed, as you think about passive versus active, and so we've had a couple podcast guests that have kind of gone back and forth on passive versus active, and now we're at this point where really there is a lot of concentration in the mega cap names. NVIDIA hit $4 trillion, first company to do it. You have companies like Palantir that really were really tiny not that long ago, and now they're becoming a bigger influence. What do you think of kind of the framework that how we look at the markets in general in terms of like how do we view this as it relates to technology just being inserted in almost every area of life? I mean, because the GICs, they really put technology as its own separate sector. But you look at Tesla, for example, and they make cars, but they also make, solar panels. And now they may be investing in, AI with XAI. SpaceX is doing that. How do you think about that? Does that change? Does it need to change? I know Kensho has spent some studies to say, well, we're looking at it the wrong way, but I don't know. I'm just curious what your thinking is on that.
Yeah. I think GICS is doing an admirable job, but nobody's perfect. I think the communication services sector maybe makes sense from what those companies do, but from a portfolio manager perspective, it's terrible. Right? You have these defensive telecoms companies lumped in with these with
Meta.
Exactly. Social media companies, traditional media companies.
Google.
Yeah. Why? How are we supposed to manage that? So, but you're absolutely right, Jim. Technology is pervasive. So to think that this is its own sector and we should treat it such is probably not the correct way to think. And I think AI is going to be a great example of that over the next 5 years. Hopefully, so many companies are going to be adopting and applying it that it's hard to say, where the technology starts and when it stops. And that could be, wonderful for profit margins, but probably make it more difficult from a GICS classification somewhere. But it has led to a very, very concentrated market. The top 10 stocks in the S&P 500 accounted for, depending on the day, can be 39% of the entire index. That's basically a record high. It was 30% in 2000, the dot-com bubble peak. statistic perspective.
Sure.
Back in the early 70s, the Nifty 50 era, it was only about 34%. So we're even more concentrated than we were at 2 times that any market historian would think of market concentration. Eventually, that music's going to stop, and it's probably going to lead to an even more severe bear market than we would have seen otherwise.
So the catalyst for that stopping is that is it valuation? But like, I feel like there needs to be something like maybe AI. Over time, it's all built and they're not building any more data centers. And they're like, okay, well, that's it. And then, the multiple needs to contract. Is that how kind of you think it plays out?
Yeah, creative destruction, tends to work. Sometimes it takes longer than others. And these companies have these fantastic moats, right? When in history have you had companies that can, at the same time, throw billions of dollars at a CapEx project that isn't profitable, and they say we don't know when it's going to be profitable, and meanwhile, oh, by the way, we're also going to pay our shareholders back billions of dollars through buybacks and dividends. It's incredible. But you think that new entrants will come in. I think DeepSeek was a reminder of that. We don't know where or how it's going to happen, but it happens. Now the catalyst is almost always an economic event. There needs to be a recession. And then during those big recessionary bear markets, the previous winners tend to be discredited. And then you get the rotation. And perhaps what happens is coming out of the next recession, whenever that may be, that's when the adoption takes place by other companies. And suddenly XYZ manufacturer, that's the AI play, where their profit margins can expand, maybe not to where the Mag 7 margins are, but they can expand, and that's where it is. Think about Apple.com. Look, we continue to adopt the internet. We kept continuing to use it in the 2000s.
Yeah,
those stocks were not great investments for years. So that's probably how it would play out. You say, give me a date. Well, I'll just say I'm going to give you the patented NDR answer which is we have indicators that we're going to follow, and they'll hopefully guide us on that. Sure,
super interesting though.
So maybe I would love to transition, kind of staying on the topic of some of the margins and earnings. I know something that you guys wrote about recently was maybe an expectation that earnings growth may start to decelerate in the back half of this year. So let's unpack that a little bit. And then very specifically, I'd love to understand, is any of that assumption of deceleration tied to tariffs, or is the tariff component wait and see within those expectations?
Yeah, I think this is something that has changed throughout the year. So coming into the year, our concern was that the law of large numbers was going to be working against the Mag 7, where after 6-8 quarters of fantastic earnings growth, double digits in just about all the cases, in some cases triple digit growth, you just can't maintain that. And so we've seen that already roll over. And I think what has changed on one hand is that those companies have already taken a bit of a valuation hit. And so their relative valuations got to about what the norm has been for the past 10 years or so. So they kind of corrected the overvaluation issue. And then also their earnings deceleration has started to plateau. So coming into the year, the Mag 7 as a group, they earnings growth last year was about 44%. Through the first quarter, it's down to around 30%. But now the expectations is around like 28 or so percent for the rest of the year. So we kind of flatlined. Meanwhile, the other 493 are probably more susceptible to tariffs. Tim Cook can call the president and say, "Hey, can you exempt this stuff?" Or NVIDIA CEO can go on a whirlwind tour around the Middle East and come back with tens of billions of dollars in new investments. Most companies would love to be able to have that, but unfortunately they don't, and they're going to be the ones that are more susceptible to the tariff issues. And so we've already seen the earnings revisions be stiffer on the other 493. So that's it. And then in terms of like the margins, what we're really watching closely right now are gross margins. So usually when you think about profit margins, think after-tax margins, because the last few cycles, that's where things have happened. But gross margins, it's just sales minus cost of goods sold divided by sales. And that's where the tariffs are going to show up, right? Is in the direct cost of the products. They've been pretty flat year to date, so it hasn't been an issue yet. But if you could start seeing those, even to get like a 2-3 tenths decline in gross margins, that can push S&P 500 profit growth under 5% for the year. And so that's where I think the rubber meets the road. And if you're a CFO, how do you manage that? Well, what's the biggest input in the cost of goods sold? Labor, it's people. And so so if you start, we've already seen the labor market soften a little bit, but what if it's like, all right, we're going to have hiring freezes, or, we're just not going to, maybe have a few layoffs here and there. And then that's how the tariffs that's our base case, but it could filter into the real economy. And then, once that train of layoffs gets going, it's kind of unstoppable.
Yeah, that's actually, I'm glad you kind of dovetailed into the topic of employment. Because that is something that I've been thinking about the last couple months. Is there's been this discussion, is like, are tariffs inflationary? Are they actually deflationary? And I think ultimately it remains to be uncertainty. And so as long as companies are uncertain as to how, when, the scope, the size, the timing of these tariffs will impact them individually, they're going to be in a wait and see mode. And to your point, Ed, that also can mean layoffs. If you're uncertain about production over the next 6 months, you might look at your workforce and say, I don't have a lot for these people to do. And in more of those, companies that they can hire and fire quickly, that could result in this feeding through, the uncertainty in tariffs feeding directly into unemployment data. It ultimately is going to drive the Fed. I know the Fed's dual mandate is price stability and full employment. I think from an inflationary perspective, again, I think the tariffs are feeding more into that employment than they are the inflationary. And again, everybody has very different views on that, just sharing mine. But that is something that I think we're going to definitely want to pay close attention to in the next few months, is the employment data. And as we start to see unemployment rate creep up, that will have a direct impact on the Fed actions, which ultimately will drive market returns, because the market is, as soon as we start to get Fed cuts, the market could see that as a tailwind. There's easing in the market that's positive for stocks, or it could be, the signal, the canary in a coal mine of, okay, now we're headed for this full blown recession. So do you guys have thoughts? I know this is a long-winded tee up of me to ask whether or not you guys have thoughts on employment data and how that is, feeding into the back half of this year, and any risks that you think exist as a result of that.
Yeah, no, thanks for sharing that. It's a really interesting thought process there. Everyone seems to be focused on the inflation side, but I think you're right. The employment's going to be key. We've seen job growth slow. The last couple employment reports, the job growth's been concentrated in a few sectors like healthcare, and there's seemed to be some sort of seasonal anomaly where the state and local governments were a big part of the hiring in the summer months when schools are out. So we'll see how robust the labor market really is. And again, our base case is that it's going to muddle through okay. But I think the tariffs can show up is going to be on CapEx and how that filters through. So let's say you have a project that you started it, you're not going to stop it because of what tariffs might be. But the next project, you may say, let's hold on a second. Let's just wait and see how things play out. If it's a 90-day pause, okay, probably not a big deal. Well, now we're at a 120-day pause. What if that becomes 180, 270? Those CapEx plans, kind of get dusty on the shelf, and that's going to filter through to the economy, because the multiplier effect of CapEx is so much greater. So if you traditional property, plant, and equipment, it's about 2.5 times. So you spend $1 on CapEx, $2.50 filters through the economy. Versus consumer spending, you buy a new shirt, it's about an extra 60 cents that filters through. So even though the U.S. economy is much more consumer based, if you're talking about the delta on growth, it's much more on the CapEx side. So that's what we'll have to see. That's my concern, is that, as an administration continues to negotiate, it seems like maybe other countries are starting to get an idea of what they're doing. They're going to drive a hard bargain, but if they're not comfortable with whatever deal they have, they're just say, all right, we'll hold off. We won't sign it. And that's just going to keep those CapEx projects from getting started. Now, as you mentioned, one big beautiful bill, the counter to that is that there were some juicy CapEx incentives in the one big beautiful bill. So some companies may say, forget about tariffs. I don't care. That's not important to me. I'm going to take advantage of the 100% depreciation. So a lot of moving parts to try to figure out, where it all ends up.
So Ed, on that topic, does your firm and do you look at things like the taxes and regulation and kind of weight that in terms of what that could mean in terms of, do we get additional upside? I think I read in one of your pieces that, there's a potential for surprises both to the upside and downside based on how things work out. I'm just curious, and then also you mentioned the CapEx spending. How about supply chains? And I'm just thinking of this example of the auto parts that come from Canada and Mexico and building a car and supply chain. And does that get disrupted? Are we going to see more disruption with that?
I think as time goes on, I think one thing whatever you think of the administration, everybody has a viewpoint. I think if once somebody can bend their ear, they do kind of understand how some of this stuff works. It will be messy and it'll be disruptive for sure. Now, one thing that as we kind of dug into the one big beautiful bill a little bit more was that the benefit, the additional spending, or actually the tax cuts, I better way to say it, the tax cuts are immediate in the case of the CapEx, and then for this year, which are kind of hit most consumers' bank statements early next year when they file their taxes. That's going to happen sooner. Whereas the spending cuts, particularly on the Medicaid side, that happens. Oh, we're going to give that to the next Congress to have to deal with. And so we'll see how much of that actually goes through, actually gets implemented. Surprisingly, Washington can't kick the can down the road. So now the vast majority of the bill, when you see the price tag, whatever you want, depending on who you listen to, $3.8 trillion in the next 10 years, most of that is just an extension of the 2017 cuts. So from a market's perspective, that's not new stimulus. But what new stimulus is coming is certainly going to be front-end loaded. So a little bit positive growth-wise for 2025 and early 2026.
So the depreciation and additional benefits that companies might see, that can serve a little bit as a tailwind. But yeah, you're like you said, the taxes, no change. They were just extended. Yeah.
Now, I think that the salt tax relief, I think that's going to be a pretty big deal for upper middle class consumers in high tax states. I'm a Floridian, so I was silently rooting to keep it at $10,000. Why am I paying for other people's taxes when I have to deal with Florida school systems?
As Jim and I are both in California, so thank you.
Yeah. I imagine you guys are quite happy with that.
Every little bit helps.
Yeah. So I mean, you tell me. I mean, that's a pretty nice adjustment to your after-tax income, right? I mean, some of that's going to be spent, right?
Yeah.
Yeah, I think that also kind of goes back into this continued discussion around the K-shaped recovery, and I know that that increase through the SALT efforts was kind of a little bit of backlash, saying, of course, the upper middle class will stand to benefit from this more so than the lower class. And we continue to see this kind of dispersion between those who have and those who have not from an economic recovery. And the reason I mention this is because a lot of the way that our, data is collected is, weighted based on the average versus maybe more of the median. So the data continues to look strong, I think, at face value, because as you look at consumer spending, it is the top, decile, the top quintile that is driving a lot of the consumer spending. And so sometimes it's hard to see through to see, how the average consumer is doing. And I think what we found through the data that is available is the average consumer isn't doing as well as some of the data suggests. So whether or not that rises to the surface and starts to come through, I think there are some cracks in the system maybe that aren't quite visible at the surface. But maybe a question for you, Ed, is Where are you seeing cracks in the system that we should maybe keep an eye on? And then ultimately would love to have a follow-up question on that, which is, what do you see as the biggest risks over the next 6 to 12 months? And oftentimes what, appends the economy is not the obvious thing. It's something below the surface until it rises to the surface. So kind of a two-part question, but related in that sense.
Yeah. Yeah. So first of all, on the consumer, I think you're absolutely right that we get to maybe lower 60% of household income consumers are as strapped as they were before the pandemic. And what it means is the economy is very beholden to job growth. As long as we're adding 150,000 jobs a month on average, the economy is going to do okay. But once that slows down, then the cushion isn't there. And look, I have 16-year-old twins, so they recently got their driver's license. So I have my evenings back. I don't have to play chauffeur. I do also check the Find My app to make sure they're where they're supposed to be, and every time I get the phone call, are you okay? Yes, absolutely, those things. But the insurance, wow. When I called the insurance company, I was floored, and they have friends who aren't getting their driver's license. Some kids just don't want to get their driver's license these days. That's just that's a thing. But some of the parents say, "Look, I can't afford it, or we're going to choose to spend our money elsewhere." And so those are the kind of choices that are made in an economy that isn't doing that great. And when I got my driver's license, that isn't anything people really thought about. I mean, sure, your insurance went up, and most of us just kind of paid our parents some extra money from our jobs and covered it. It wasn't a big deal, and that's a haves and haves not kind of economy. In terms of the unknown unknowns, I thought there's a great article this morning in the Wall Street Journal talking about Jamie Dimon and what JP Morgan is doing with the private credit market. On the one hand, Diamond says this is a disaster. On the way, on the other hand, we're going all in, and because he kind of feels like he has to. And so as the administration deregulates, and Jim, you mentioned that, and I really didn't get to it, but this is another positive that maybe some of those shackles have been removed. Now we know a lot of times it goes very well for a while, and then eventually, somebody or a group kind of takes things a little too far. I'm very concerned about the private equity, private credit part of the market. It's opaque. I don't think a lot of these marks are legit because companies haven't really been going public. You get a company in a private equity fund, and the company wants to sell it, and they can't sell it to another private equity firm or to a strategic buyer. Well, why don't you just go public? Because valuations for public equities are pretty high. They're not. Why? Because they don't want to get the mark, because they know it's not marked correctly. That's something that shows up in the next recession. And the banks the Fed's not regulating it. So, do you really expect the taxpayer to kind of go, oh yeah, these institutional investors that brought these private equity companies, we're going to bail you out? I mean, that's going to make the financial crisis. I mean, Michael Lewis probably already has written half the book on this, so that's going to be a challenge. I think that's the next crisis.
Do you think part of that is just, this transition with the baby boomers? And I don't remember the statistic, but how many thousand baby boomers retiring every day, and I look at things, I look at the unemployment too, and there's 103 million people that are not in the workforce. Obviously, you have some that are on disability, but you have more and more that are retiring. Some are retiring earlier than normal. And then you have this huge amount of cash, like 7.1 trillion in money markets. If you add checking and savings account, the money under their mattress, that's like 27 trillion. And it's way, way off the trend line from, looking at many years. And do you think that part of this is just, demographic changes? And I read a piece that talked about, the second homes in the ski resorts that, a lot of them are just selling them. They don't want to maintain them. They're getting older and they're not doing the same family vacations. Curious, does all that kind of fit together, or should we be viewing those as totally separate, independent?
I think you're exactly right, Jim. Yeah, these things are so connected. The older you get, I think you guys know better than I do, but most people tell retirees to have 18, 24 months of liquid reserves in case the market's in a downturn. You're not selling into weakness. So that's part of it. Part of it, interest rates are higher. For years, we told investors don't expect these double-digit returns. Mid-single digits are what you expect. And I said, wait, I can get mid-single digits in money market funds. So why don't I keep more in there? And so that's part of it. So I think if interest rates were to be lowered, I think some of that money would come out off the sidelines. But I think there's a lot of demographics in here. And again, as a Floridian, we've felt it. The housing market absolutely exploded, but now you're seeing it soften quite a bit as supply comes on. It took a few years for supply to come on, and then some people are moving back up north. They decide they didn't maybe living in 110-degree heat for 6 months out of the year surrounded by alligators wasn't for them. But I personally like it. But I teach their own. But I think also this SALT deduction is a big deal too. Because some people did that arbitrage. If that's just a little bit less favorable for low tax states, maybe that's part of it. So all of this is absolutely connected. Now, just to kind of put a positive on it, there's going to be this massive wealth transfer over the next decade to millennials. Also, it's a tougher environment in the sense of if you don't have financial literacy, if you're hoping for a pension like people did a generation ago, you don't have that. But if you plan ahead, and if you're a young person and you do your employer match and you start saving early on 10, 15% of your income, there's probably no time in history that you couldn't set yourself up to be independently wealthy, depending on how you want to define it, but comfortably wealthy as you move towards your retirement years, if you're smart, and that's a very exciting proposition for people. But you have to set yourself up, and I know it's easy for me to say as a Gen Xer, right? If I was a Gen Zer and starting off and trying to, your rent's high and job market's getting tougher and so forth. But I think there's some excitement here about, I think there should be, about the opportunities for people that can direct their own investments.
Yeah, I would think too. I mean, I just consider I entered the workforce in 2011, and thinking about the sequencing risk of essentially almost every calendar year has been pretty attractive equity returns. Ultimately, I'm saying this because as you think about the younger generation, the importance of investing in the stock market is, I think, increasingly important for them to reach their retirement goals, because they don't have this safety net of an embedded pension and support. And I mean, there's always the question too, is Social Security going to come through for us when we need to retire, which ultimately makes, investing early for compounded returns even more important for the younger generation. And so the education behind that. But ultimately too, it's all about that sequencing risk. You can look back at times when people entered the workforce or when they were at their peak earning years. If you were nearing retirement and 2008 hit, that completely derailed you. And so it's thinking about how you can get invested in the market, and hopefully from a timing perspective, you don't have those, once in 100-year events that would kind of kick you off your goals. But I think that's super important. But Jim, I think you were about to ask a question. I cut you off.
Oh, no, you're good. I was just going to add that, I feel like now probably more than ever, it's more important to have a good financial advisor and to work with them. I'm just thinking about recently, we have this whole meme stock craze and Bitcoin and crypto. And by the way, we believe there's a small place of the portfolio that could have something like that, like a crypto. But if you're doing it yourself, I feel like there's a lot more opportunities to get hurt because the market just seems a little bit more fragile. I don't know what your thoughts are, Ed.
It's always fun to talk to your friends about whatever meme coin that you bought, but that's not a long-term solution for wealth. Most people have day jobs, and so to try to time that over the long run is very difficult. When I got started in the '90s, everybody had their internet stock that they were bragging about, and then I don't know, about June of 2000, people didn't talk about that stuff anymore, and I don't think everyone sold in March. Certainly have a long-term plan. Sure, have some of that, for your risk bucket makes sense, but have somebody that can guide you is probably much, a prudent use of whatever 1% or whatever amount that advisors are charging.
So I feel like we talked a lot about risks, uncertainty, things that, might reflect small cracks in the system. And I feel like we're kind of rounding home, and the conversation's turning slightly positive now, which I like. So I like to end on a positive note. So as it relates to any research that you've been undergoing and just looking over the next 6 to 12 months, pockets that are a little bit more rosy. I think oftentimes too, it's so easy as an investor to dwell on what could go wrong. And oftentimes that means to miss the upside because you're sitting on the sidelines, you're sitting in cash, you're, taking on way less risk than you should be to reach your retirement goals. So, what can we get most excited about over the next 6 to 12 months here, Ed? Like any unique areas or interesting areas of research that you guys have dug into recently that paint a good picture for us?
Yeah, I think you alluded to it earlier, so I'm glad you gave me the opportunity to come back to this, and that is if the Fed does cut a couple of times, it's not usual for the Fed to cut like it did and then wait this long and then start cutting again. Usually they wait this long that then the easing cycle's over and the next move is a hike. But we looked at times the Fed waited 6 months or longer, and the returns over the next several months tend to be very good. If you take, say, the 3 months before and the 3 months after that first cut, after the long pause, which would basically be right at that September Fed meeting, S&P's return on average 14%. Wow. So there's a nice counter to all the doom and gloom that we've talked about, is that, the Fed coming back and feeling confident that they can cut. Usually at this point, that means you're not going into recession. It just means whatever inflation concerns they had that caused them to stop cutting have gone away, which is exactly what would be the environment should the Fed be able to. And I think there is room, even if inflation goes a little bit higher, because the real Fed funds rate is a little bit high compared to history. So they could cut a couple times and without inflation falling, and policy would not be too accommodating.
Yeah, I'm glad you mentioned that. There's been quite a bit of research, especially with the historic rally that we saw coming out of April lows. Thinking about, first half of the year performance, thinking about, the shortness of that duration of that rally, like all of these signals, at least historically, when you look at the data and the point that you just made too about the, time between Fed cuts, et cetera, are all pointing to very optimistic upside further within U.S. equities over the next 12 months. A lot of the figures I've seen thrown around are, low double digits all the way up to, 15-20% return potential over the next 12 months. So I try to think about like glass half full, and we've addressed many of the risks that kind of lie, right below the surface. But until we start to see those meaningfully come to the surface, I think as an investor, you have to be longer term. You have to think about the risks that you're taking. But it historically has not benefited you as an investor to sit on the sidelines, being invested and thinking about all the positive attributes we've talked about, whether it be earnings growth continues to look attractive, employment data, at least for now, is, relatively stable. Inflation is coming back down to some reasonable levels. So I'm optimistic. We put out our half year report for the Wealth Consulting Group. I'm on the more bearish side of being bullish. I think we labeled me as being pragmatic. So we have varying levels of our bullishness, but I think all of these signs that you've shared today point us to continue to have a bullish tilt in our outlook.
Yeah, well, great. And I'm just going to add one more thing here, and that is we love a ton of technical indicators. Won't get into all the nitty gritty. We could spend a whole hour talking about.
Oh, now Jim's looking up.
Yeah.
Go ahead.
Yeah. But we got in late April, early May, we got a series of these signals to the point that these only happen every couple years at most. And so that and the future returns after you get so many of these signals tend to be really strong. And often what happens is you get the signals and there's a lot of head scratching and consternation. And then a year later, with the benefit of hindsight, you say, oh, well, this is why the market told us this. That's the beauty of technical indicators is they give the information sooner than the fundamentals. So that's certainly a positive for the markets is that they're behaving like they want to go higher.
Sounds like you're
Jim,
referring to a breath thrust.
Yeah.
Yeah. Breath thrust, funny term. I don't know who came up with it. I think Marty Zweig may have been it. You guys are on X or Twitter or whatever you want to call it. The Zweig breath thrust occurred in late April in the financial
and
Twitter.
That was actually, it was the day before or after around that when you presented to the CFA Society of Orange County, because I remember you had mentioned that it was happening real time. And we've had quite a few guests on our podcast that we've talked about that since. And Jim is a CMT. So when you said I have a couple of technical signals, like I saw his ears perk up. So Jim, if you have any other questions on some of those other
I guess the other question, we're very bullish when it comes to AI and we're more bullish than some of the other folks out there. But I guess one question related to that is kind of the second, third derivative, the beneficiaries of AI, the companies that are using it. How long do you think it takes for, the other 490 or, 493 and then the next, the 2000 companies? Because I feel like some companies are really going all in on it now and they're benefiting and they may be able to cut them costs. They might also be able to improve their revenue. Right. In some ways of targeted marketing, things like that. How long do you think it takes before it gets fully, into the market with those other companies?
Yeah. So I'll give you a real broad statistic, and that is when there's a surge in CapEx, U.S. GDP usually doesn't reflect that for 5 years. So you have the initial kick of the CapEx itself, but in terms of the CapEx and the benefits filtering through, it's 5 years. And of course, some companies are going to be early adopters, and some are going to be later.
Sure.
So there's a long tail to this. Now, one thing I feel fairly confident is that the idea that everybody's going to lose their job I don't think that's how this economy works. I read an article a few years ago, wish I'd kept it. It was a New York Times article from the turn of the century about these horseless carriages that are taking all the jobs from the carriage drivers. I think we replace them just fine. Now, if you want to sit around and code in Java for the next 30 years, you're probably not going to have that job. But there can be other jobs for you to do. So it's going to be disruptive, but the labor force will continue to be productive, and we'll figure out what that is. But yeah. So if you want to, it's just going to take several years, I think, for this to filter through to other companies.
Interesting. And then the productivity gains, we probably haven't seen that yet either. When we look at productivity data, it's probably going to take a while for that to show up too, right?
Absolutely. Yeah. That's part of that 5-year growth is in the productivity.
Awesome. Well, Ed, is there any topics that we didn't discuss or touch on today that are near and dear to your guys' heart at Ed Davis?
I think we covered the gamut. Yeah, I enjoyed the conversation. That was awesome.
Yeah, no, like I said when I opened, I really appreciate the research that you do. I appreciate the insights. I think they're very balanced. I think they're very insightful, and I think they're really relevant. I mean, coming into this year, I think everybody kind of got whipped around and thrown upside down, and all of a sudden it's halfway through the year and we look back, it's like, hey, markets actually look pretty good. There's not anything to be like too concerned about right now, which is precisely the time we should be questioning, but in a constructive way. And I think a lot of the comments that you shared today do paint this constructive picture. Continue to see market gains, but be cautious, think about diversification. So really appreciate your insights and joining us on the podcast. And we'll continue to look out for more research from Ned Davis. But really appreciate you having on. And Jim, thanks for co-hosting with me.
Yes, thanks so much, Ed. Appreciate it.
Come and dance on our floor. Take a step that is new.